Hey, it's Alicia. Other members of our group, also known as the Toys business, include Margot, who will talk us through market value and share prices, Simran, who will explore the many factors impacting those share prices, Danica, who will talk about both market and book value, and finally JY, who will introduce our listed company in the NZX and calculate the market to book ratio for our company. This will ultimately decide if our company should invest or shouldn't invest in our listed company, which is the Warehouse Group. But before we get into that, we must understand the implication of value in a business. According to HBR.org, a business's value depends on the beliefs and the principles that ultimately drives the business itself, because they impact the relationship it develops with the shareholders, employees, and most importantly, customers. Because of this, every business tends to have different values depending on the aim or the overall goal of their business. Although before we can measure the value of a business, it is important to understand two important valuation principles. The first principle states that the value of a business changes over time, whether it be a publicly traded company or a private company. Changes affecting the value of the cash flow that a business is expected to generate in the future include changes in the economy, the conditions of the business or the industry, and the financial decisions made by the managers. As a result, it is important for businesses to state a valuation date, which is the date that is specified for analysis. The second principle states that there is no such thing as one value for a business, as values can be different for different investors. This is because different investors have different reasons and/or benefits from owning a business. These include having different skill levels and abilities and different preferences to the way they operate within a specific business. It is important for every business, as well as our own, to set goals as it helps guide them in a positive direction and helps business owners in making future financial management decisions. The role of management should not be to base their goals on reducing costs or maximizing profits, because it doesn't directly account for a company's cash flow due to the fact that costs and profits can be easily manipulated over time, and because businesses are not rewarded with the appropriate return of risk-taking. Therefore, it is important for businesses to account for a company's cash flows whilst also taking both the timing and the riskiness into consideration. As a result, an appropriate goal to the financial management of a business such as ours, the Toys business, and the aim of managers within our business would be to maximize the current value of our company's shares, because it is much easier to measure the market value using the share price.
I'm Margot, and I'll be discussing market value. Market value is the value of a business to a typical investor. Essentially, it is what a person is willing to pay for a company. Market value is considered to be forward-looking, as it is mainly concerned with future cash flows. Market value is also commonly referred to as the market capitalization of a publicly traded company. The value of a company can be impacted by the management of company-driven factors such as cash flow, growth, and risk. Share price is the amount it would cost to buy one share in a company. The price of a share is not fixed and fluctuates according to market conditions, which are influenced by how successful the company currently is. Share prices are impacted by market-driven factors, such as mood, momentum, and economic factors, such as natural disasters and war. We can measure market value using share prices. This is done by multiplying the number of outstanding shares by the current share price. It is important to consider price when making an investment decision, as the price you pay will determine the success in your long-term returns. Price tends to fluctuate and change depending on outside factors influencing the market. This is why the timing of your investment decision is also important to the success of your investment.
Hi, I'm Simran, and I will be discussing the factors that may impact the share prices of a toy business that has been operating for 2 years. The company's share prices are affected by numerous factors, including internal and external conditions. The managers have little or no control over the external conditions, such as general economic conditions, which is the environment that the business is operating in. This includes economic shocks such as war, natural disasters, and the most current one, COVID-19 pandemic, impacting the global economy. Other external conditions are the business environment, which is changing it from global to local scale, which provides for new government regulations such as corporate laws, environmental regulations, procedural safety regulations, and tax. Additionally, other external conditions are the economy that is beyond the company's control, include the level of economic activity such as recession and expansion, level of interest rates, and consumer sentiment. Therefore, these are the current share market conditions, and these are continually changing. Hence, the company has to consider the impacts of changes and create a new strategy and make formal decisions regarding the business. Alternatively, the controllable factors of the company that affect the cash flows are the line of their business, which is what the company does and controls. Other controllable factors are the financial management decisions such as capital budgeting, financing the company, working capital management, product quality and costs, marketing and sales, as well as research development. All these factors will impact the future expected cash flow, which is the magnitude, how big the cash flow is going to be, timing, when the cash flow is going to arrive, and the risk, how risky the cash flow is going to be. Therefore, these are the controllable from the company's point of view, and these will impact the underlying intrinsic value and also result in share prices. Therefore, the current share market conditions will move the price higher than the fair value or lower than the underlying value depending on what market sentiment is, as well as some other things the management is doing.
Hi there, I'm Danica and I will be discussing what book values are. Market value refers to the current or most recently quoted price for a market traded security. It can also refer to the most probable price an asset, like a house, would go for on the open market. A company's market value of equity differs from its book value of equity because the book value of equity focuses on owned assets and owed liabilities. The market value of equity is generally believed to price in some of the company's growth potential beyond its current balance sheet. Market value is what people are willing to pay. This is called forward-looking, also known as market capitalization. Book value of equity is what shareholders have put into the company. This is called backward-looking. The book-to-market ratio is used to find a company's value by comparing its book value to its market value. A company's book value is calculated by looking at the company's historical cost or accounting value. A firm's market value is determined by its share price in the stock market and the number of shares it has outstanding.
Hi, this is JY. I would like to introduce our list company, Warehouse Group. The Warehouse Group is the largest retail group operating in New Zealand and consists of Warehouse Stationery, Novel Living, and Tordo 7. Our business has operated for over 2 years. The market price of Warehouse Group is 2.24 on 9th of June 2020. The value of market capitalization is 776,928,589 on 9th of June 2020. And the most recent total equity is 365,050,000. What is the difference between the company market capitalization and the book value of total equity? The market capitalization, also known as market cap, is market value of all the company's common stock. The book value of total equity is accounting value of the claim book shareholder have on the company's asset. The market-to-book ratio is the one of the most commonly used to determine if the company's stock is cheap or expensive and also undervalued or overvalued. Dividing their market cap by the book value gives the market-to-book ratio. The value of the Warehouse Group market-to-book ratio is 2.12, which is greater than 1. This means the market overvalued the company's stockholders' equity, which means investors like us believe its stockholder equity is worth more than accounting value on the balance sheet. Thank you.
In summary, after calculating the market book ratio, which is 2.1, meaning that a share price is overvalued, the ratio is now greater than 3, meaning that it's expensive but not overly expensive. We have decided to invest in our NZX listed warehouse group because although the share prices are overvalued, there are many factors to consider when investing in company shares, such as factors affecting the share prices of the warehouse group company.
Done.